Hello everyone, welcome back to our channel and welcome back to another episode of Capital Insights from Punjab Capital Research. In this video, we're going to be talking about the distribution reset and we're going to focus on topics like AI labs, incumbents, and private equity in the enterprise software realignment. Let's start with a bit of a context out here. A cluster of announcements across the past 72 hours describe a coherent reorganization of how the artificial intelligence is being commercialized across the enterprise software sector. Adobe has moved to defend its franchise with agent-based platform at a moment when its equity has shed roughly 30% year-to-date. BlackRock is deploying an internal agent fabric that hints at significant restructuring of knowledge work inside the world's largest asset manager. OpenAI has widened its consulting channel to compete more aggressively with Anthropic for enterprise distribution while simultaneously entering advanced discussions on private equity-backed vehicles that would embed its tools across hundreds of portfolio companies. And SpaceX has secured a $60 billion option on Cursor, collapsing the model provider and the application layer into a single vertically integrated stack. Taken together, these events describe a market in which capital allocation, channel partnerships, and agent architectures are converging into primary competitive weapons of the AI era. The implications for the incumbent software multiples, private credit exposures, and concentrated AI equity positioning are material out here. With this context and background, let's do a deep dive into each of these announcements. First and foremost, we have the incumbent defense, that is Adobe's agentic gambit. Adobe's launch of its CX Enterprise Agent platform, together with the accompanying coworker offering, marks its most explicit attempt to reposition against the native AI entrants. The company has confirmed partnerships with more than 30 AI platforms, including Anthropic, OpenAI, Microsoft, Amazon Web Services, and NVIDIA, framing model providers as infrastructure layers whose token consumption would route through the Adobe applications. The strategic logic is legible. If application-level workflows remain sticky, foundational model substitution becomes a cost input rather than a competitive threat. However, what we are seeing is that the equity market remains unconvinced about it. Shares have declined approximately 30% this year, and the outgoing chief executive's departure after 18 years introduces leadership uncertainty at a moment when the competitive environment is most fluid. The recent revenue growth of 12% to roughly $6.4 billion in the quarter ended late February confirms that the franchise has not yet impaired, but the market is pricing a discount against the risks that AI-native challenges, including Canva's updated agent platform and Anthropic's newly released cloud design tool, erode the creative software's moat. The broader signal out here is that governance, regulated deployment controls, and enterprise data gravity are emerging as defensible layer for established vendors. Whether the defense holds against the several $100 billion addressable market dynamics now in play is question that every public software franchise faces in parallel. Next, let's talk about the buy-side blueprint, BlackRock's internal AI fabric. BlackRock's rollout of Rock AI to 5,000 in-house developers with subsequent firm-wide extension to non-technical citizen developers represents the most concrete articulation yet of what an AI-native asset management operating system looks like. The firm's research platform, built on approximately 150 fundamental equity users in 2024, has established an internal precedent for agent-driven investment research spanning earnings reports, regulatory filings, and proprietary data sources. Extending that pattern across all the investment division compounds the operating leverage available to a firm that's managing roughly $14 trillion in assets. The labor market implications are also non-trivial. The senior engineering leadership describes a near-term state in which roles become cross-functional and organized into smaller oversight squads rather than specialized seats. Across the asset management industry more broadly, leaders will be distinguished by data quality, governance depth, and the scale of capital directed towards these build-outs rather than by model access itself. The 3 to 5 year horizon for full workforce reimagining is consistent with the gradual re-rating of operating margins across the sector rather than a near-term cost takeout shock. Now, for the allocators, the meaningful question is whether BlackRock's approach constitutes a proprietary moat or a template that diffuses across the industry. Given the accessibility of foundational models and the maturation of the agent orchestration tools, the diffusion scenario appears more likely out here. The benefits accrue to the largest firms first but are not permanently ring-fenced, which implies the continued AUM consolidation towards scale players over the medium term rather than a structural step change in relative profitability. And then we have the channel war, OpenAI's consulting architecture. OpenAI's decision to formalize a Codex consulting partner program with Accenture, Capgemini, PricewaterhouseCoopers, and other firms is an explicit response to the distribution advantage Anthropic has built through its coding franchise and agent products. Weekly active Codex users have reached 4 million, up from 3 million 2 weeks earlier and 2 million in the month prior. If sustained, then this space places the product amongst the fastest scaling developer tools ever deployed. The newly appointed Vice President of Global Partnerships and Ecosystems arriving from Google Cloud will oversee the program. The strategic shift embedded in the announcement is the explicit extension of coding agents beyond the software engineering into marketing, finance, and sales functions, effectively collapsing the distinction between AI coding tools and general knowledge work automation. The combined positioning of Codex with OpenAI's Frontier Agent Development Platform released in February suggests an attempt to own a cross-functional enterprise surface area comparable to the category that Anthropic has opened with Cloud Code. Consulting firms have emerged as a primary distribution layer for both the companies, a dynamic that mirrors enterprise software adoption cycles of prior technology generations. The key question is whether Codex growth can be sustained against Anthropic's entrenched developer mindshare, and whether the consulting channel provides durable differentiation or simply commodifies this layer also. Next, let's move to capital as distribution, the deploy co-thesis. The most structurally significant development is OpenAI's advanced discussions to commit up to $1.5 billion to private equity-backed joint venture internally referred to as DeployCo. Now, according to Financial Times reporting cited through wire sources, the venture is structured as a Delaware LLC with initial $500 million equity contribution from OpenAI and an expected valuation of approximately $10 billion on closing targeted for early May. The private equity investors, including TPG, Bain Capital, Advent International, and Brookfield Asset Management, are expected to contribute roughly $4 billion collectively, with OpenAI holding super voting shares and retaining an option to deploy a further $1 billion at a later stage. The investor return structure reportedly includes a 17.5% annual guaranteed return over a 5-year horizon. The economic architecture out here is novel. By embedding its tools across portfolio companies of 4 major alternative asset managers, OpenAI obtains distribution across potentially more than 1,000 operating businesses without individual enterprise sale motions. For the private equity sponsors, the vehicle provides a standardized AI deployment layer across portfolio companies that have historically struggled to execute technology transformations on their own. The 17.5% guaranteed return is structured as a preferred tranche that resembles a private credit-like obligation rather than pure equity upside, effectively converting part of OpenAI's equity-adjusted capital into a coupon-bearing distribution commitment. Anthropic is also reportedly in parallel discussions with Blackstone, Permia, and Hellman & Friedman on comparable vehicle with approximately $1 billion in investor capital. Now, the emergence of 2 distinct private equity-backed distribution consortia within the same quarter indicates a new phase of competitive dynamics in which AI labs are using capital structure, not only product performance, as a distribution weapon. What's really important out here is that the implications for the enterprise software valuation multiples are substantive. If a meaningful share of operating companies within mid-market private equity portfolios adopt OpenAI or Anthropic agents through these vehicles, the replacement risk for individual software line items increase structurally. The current drawdown of roughly $300 billion in software and data services market capitalization is consistent with investors beginning to price this risk directly rather than in abstract. And finally, let's talk about the vertical stack play, SpaceX and Cursor. SpaceX option to acquire Cursor for $60 billion later this year, or alternatively to settle for a $10 billion payment partnership, is the most aggressive recent example of application model convergence. Following SpaceX's earlier absorption of XAI, the structure gives the combined entity control over the Colossus training complex in Memphis, the Composer in-house model Cursor launched last fall, and the Cursor developer-facing application that competes with Cloud Code and Codex. Cursor's prior valuation of $29.3 billion set in November of 2025 implies a step-up of more than 2 times in roughly 6 months, driven largely by the strategic value of an integrated developer application layered on top of a more controlled model stack. For SpaceX, which is preparing for a substantial public offering, the acquisition option both signals scale ambition and pre-positions that combined entity as a third foundational model plus application competitor alongside OpenAI and Anthropic. The longer-term orbital data center aspirations, while speculative, fall into the same integrated stack thesis. What's important to note out here is that the broader industry implication is that pure-play AI application companies reliant on third-party model access face increasing strategic vulnerability. Cursor itself launched Composer specifically to reduce the dependence on OpenAI, Anthropic, Google, and XAI model pricing. The SpaceX option effectively validates the integration direction as a dominant part of the defensibility at the application layer. In closing, we can say that the events of the past several days fit together as the opening movement of structural reorganization in enterprise software economics. AI labs are no longer competing primarily on model quality, they are competing on channel architecture and capital structure. Incumbents are responding through agentic platform launches that attempt to preserve application layer lock-in. Asset managers are deploying the technology internally at scale. Private equity is being drawn directly into the distribution infrastructure, introducing credit-like return obligations into the AI capital stack. What's important to remember is that the investment implications span public software multiples, private credit exposures, and the competitive positioning of the foundational model providers themselves. The next several quarters will test whether these structural shifts translate into sustained divergence in enterprise software earning trajectories or into broader market-level re-rating. Now, that's what we wanted to share with you in this episode of Capital Insights from Punjab Capital Research. Hope you found the episode insightful. Stay tuned in for our next edition.